Welcome everybody from around the world. This is a rare opportunity and the first thing I need to mention is everybody can speak, and Sebastian will take questions at the end of his demonstration. In the meantime, the fact is that since you can speak, we can hear everything in the background. So if you have children or phones ringing or playing music, it's going to interfere with the quality of sound for everybody around the world. So if you can mute yourself or make sure there's no sounds in the background, it'll be a wonderful experience for all of us. See, even right now I can hear stuff in the background. So, and I don't think I'm in a position to remute people here. So since I can't mute you, I need you to be, along with the rest of us, quiet while Sebastian speaks. What you see in front of you is people who knew about market manipulation. We're talking about market manipulation, price and volume. Price and volume has worked for over 150 years, and it's going to work for the next 150 years. Daniel Drew was a member from the Gilded Age, and in the Gilded Age, he's talking about market manipulation. In his memoirs, he spoke about a run on the greenback, which was shorting the dollar. Then we have Richard Wyckoff, and Richard Wyckoff wrote many publications, and he also wrote a newsletter, and this is the basis for Tom Williams learning how to read the market and how the pros control price. And then my mentor came along, Richard Ney. And after Richard Ney came along, Sebastian's mentor, Tom Williams, the inventor of volume spread analysis. I've had the privilege and the blessing to know Sebastian and Tom since 2003. And I implore you to listen to what Sebastian has to say. You're going to get a perspective considerably different than what you've ever heard before. So I want you to take advantage of it. And now I'm going to turn the screen over to Sebastian, make him the presenter, and let's hear what he has to say. There we go. Over to you, Sebastian.
Okay, thank you very much. Okay, I'm just okay. So, can you see my screen, everybody?
I can see your screen, thank you.
Okay, should say key attributes of a successful trader. So, can the audience see my screen as well? You can type a Y in the chat thing, or there's a chat thing. Okay, that's great. Thanks, Boris. Okay, all right. Okay, so the reason why there's a man sitting in front of his computer with his head on his hands on his head is because this is not an easy business at all. It's a very, very difficult business to succeed in. And so I don't want you to think that it's easy in any way. I don't want you to think, this is an easy game, not by any stretch of the imagination. So what I've done is, last year I actually went for a workshop, a proprietary trading firm in London called Futex, and I did a lot of training with them, and it gave me a completely different perspective. There's a lot of things that I was missing, and this helped me to fill in a lot of those gaps. So now I can give you some sort of a professional background, at least how a professional trader would approach his profession. So let's talk about what makes a retail trader to fail. Right. So retail traders focus on the money they can make. Okay. So it's not about how much money you can make, which may sound a bit sort of alien to a lot of people, but it's actually what you don't give back. What is the point of making $500 today and then you lose $1,000 tomorrow? What is the point? So don't focus on the money that you think you can make, because that will probably work against you, because you'll be trading your P&L. Okay? What you've got to do is you've got to focus on the process of how you came to that decision, believe in that process, and not be absolutely rigid in that process, but be flexible, because market conditions can change. There are 4 different types of market. There is volatility with low volume, there's volatility with high volume, there's a trending market, and there's also a bracketing range market, which is what I call a ranging auction market, which will just go up, down, up, down, up and down, up and down. It just doesn't really go anywhere. It's not volatile, but it just sort of doesn't seem to have any sort of direction at all. It's just sort of ranging, like a range-bound market. So retail traders don't have any money management regime, okay? They don't cut their losses, but they allow their losers to run, right? But they cut their profits short. Now, this must be a psychological thing, because even if you read Richard Wyckoff's book, The Ventures and Adventures Through 40 Years, and any of his other books, he talks about this. He talks about how the public would go to the bucket shops. They would put on a trade. They would take a quarter of a point profit, but they would put up more margin to keep the losers afloat. Okay? If your trade goes against you, you've got to cut it out, because if you don't, that's a good way to go bust. All right? You've got to trade where you've got a profit to loss ratio for every, say, if you have, say, like a 5-tick stop loss, you want to be aiming for a 10 to 15-tick winner. Okay, and if you get more than that, then you're doing very well. But the average is a 3-to-1 profit to loss ratio. So keeping your losses as small as possible is absolute key to success in this game, and not thinking about what you can make. I've got people coming in all the time, so I might have to repeat myself a couple of times when I see the numbers ticking up a bit. But it seems common sense, but you'd be amazed how many people can't actually follow it. And it does actually, I believe, a psychological barrier. I think that people get very emotional about their trades, and they can't actually just sort of coldly focus and just follow their sort of set of rules. The next point is not keeping a journal. I keep a journal, I keep a video journal, and I make notes as well. I'm going to show you some of the notes that I make. I've just switched my brokerage account. I've got Trading Technologies now, which is the professional industry standard. I don't know if any of you have heard of that, but you can Google that. So I am making a video journal, and I will be going back to, I've actually got a journal that I've got on Google Documents, but it's when I used to use charts, so I don't believe it's really relevant to what I'm talking about at the moment. I mean, considering that, you know, I've just gone to order flow, and so I just focus on the ladder. So you've got to keep a journal, and in the journal you would focus on how you did that day. You would focus on your emotions. So how did you feel when you placed a trade? Did you feel any sort of discomfort or fear, perhaps? Did you perhaps have a fear of pulling the trigger when you saw an opportunity that the probability were on your side? And and another thing you'd use a journal for is keeping stock of your bad habits, because as retail traders, you will have a lot of bad habits, such as not following your trading plan, things like that. And it's very important to have a trading plan. And I have a trading plan. I'm going to just show you my trading plan. It's just a very simple one, and I'm adding to it all the time. So, so not keeping a journal. A journal will help you to track your progress, and it will also allow you to track your emotional progress as well. So the next topic would be, they don't work on the mental analysis, only the technical edges, and your technical setup, so your edge, is only 7% of the picture. About 95% of trading is actually psychology. It's about managing your feelings and emotions and your fears, because 95% of people, they trade on emotion and fear, and it can actually get in your way. So this is something that you need to be aware of and to work on, and keeping a journal is a very good way of doing it. A couple of really good books is Mark Douglas, Trading in the Zone, and The Disciplined Trader. They're very good books, and I would strongly recommend that you get a hold of a copy of those, and you at least read them a few times. You don't have to worry too much about your technical setups. I think Joel is probably going to handle most of that for you. But you do need to work on your emotional side, because you don't want to be trading on fear, and you certainly do not want to be emotional. And also, you don't really want to be trading on euphoria as well, because that can be just as bad as trading on fear. And there's no point in trading on hope, where the market goes against you, and you hope it's going to go your way, because the chances are it probably won't. And this is where money management comes in, and cutting your losses early rather than later, because your objective is to come back to your trading desk the next day. That is your objective, to keep enough money in your trading account so you can come back the next day. And another thing, you can't dwell on your losses. Okay, that's another thing you cannot do. You've got to make a spreadsheet of your winning trades in one column and your losing trades in the other column, because you will make losing trades. It's just part of the business, and you should think about losers as a business expense. Okay, so you would put those in another column, say on an Excel spreadsheet, and what you would do is you would add up all your winning trades, and you would express that as a percentage, and you would add up all your losing trades, and you'd express that as a percentage, and then you would work off your percentages, and that's where you would be able to see what you're doing right and what you're doing wrong. And hopefully, if there are errors in what you're doing wrong, such as not following your trading plan, or just getting distracted, or just doing things that you shouldn't do, then that should help you to focus on where you're going wrong and fix those errors, because and that should go in the journal as well. So,
excuse me. We can hear children in the background. Somebody's life is going on while Sebastian's talking. Could you mute yourself?
If you don't mind just muting your microphone, unless you want to talk. Just mute your microphone, please. Thank you, Jeremy. Okay, I think somebody's got an open mic somewhere, and They're probably away from their computer or something like that. So there was a lot of background noise, but I'm just going to continue, okay? So what makes retail trader fail is method hunting. That's another, that's something else where the retail trader will fail. So what happens is that what they'll do is they'll buy an off-the-shelf trading system or a set of indicators, and then what they'll do is they will trade those indicators. That might be a trading system where it only makes money, say, like in a trending market, right? So then the conditions of the market will change, and then if the market goes from being a trending market to a non-trending market or a volatile market or a sideways rotational market, then the trading system is not going to continue to work. So what they'll do is they'll bump it, and then they'll go back to the trading. Not the trading. They'll go back to the drawing board, and then they'll buy another off-the-shelf system. And then they'll trade that. They may win, they may lose, they may have a mixed picture at the end of it. But then when the market conditions change, what they'll do is they'll dump that trading method, and then they'll go off the shelf and they'll go and buy another trading system off the shelf, and then they'll go and trade that with success or failure. And what you've got to understand is that no trading system, no mechanical trading system is going to work 100% of the time. Okay? It's not. It's never ever going to work. I know of guys who work in hedge funds, and they have actually said in writing, they put it on their website, that in the 20 years that they've been in the game and they've been programming systems to actually algorithms, they have never ever come across in 20 years one trading system that will work in all market conditions. Okay? So you have to be very flexible when you're looking or you're implementing your trading system. You also have to test it. In what market conditions does your trading system work best in? And I'm assuming that you're looking at price and volume, and you're not really probably looking at other things, but other people do look at Fibonacci levels, and they could put other things on there. I don't use any of that, but so people do add in other things. So you need to try and figure out, when is the most optimal time that your trading system will work. There are times when VSA will look extremely difficult, or price and volume will be extremely difficult to understand, and it's just about understanding the basic underlying conditions of the market that you're looking at. Okay, so if we take example crude oil, which is what Joel likes to trade, it can be very, very volatile at times, especially when you have the crude oil inventory data. So if there's a big draw on oil, crude oil inventories, then the price will shoot up. And obviously, if at the facility they have a lot of crude oil coming in but not much going out, obviously price is going to fall. So supply and demand. The underlying principles are supply and demand, but what you've got to understand is that the market mostly moves on manipulation of the order book. Okay, and that's how professional traders make their money. Yes, fundamentals is a part of it, but don't forget you've got computers which are not running off fundamentals. They are programmed to understand and take advantage of human behavior, mostly human emotions and human fear, and that's what most of these algos are running off. And they're also running off the tape, off the order book. So I'm going to go to the next slide now. So other bad habits that retail traders have is that they have an ego and they want to impose their view on the market, which you cannot do. You've got to think of yourself when you're coming to the trading desk and you want to you want to trade for the day. You've got to imagine yourself as you're actually in a dance, and the market is your dancing partner, and you've got to allow your dancing partner to take control and to lead you across the dance floor as such. Okay, so you have to accept that you cannot control the market, that the market is going to control you, and what you need to do is you need to figure out the ebbs and flows in the market and try and trade in harmony with those ebbs and flows, and not try and stand against it, because the market will run you over like a freight train. okay, and it will take all of your account money and you'll blow up your account, which is the worst thing you can do, because that means that you won't be able to come back and trade the market in the future because you'll be out, okay? So this is why cutting your losses short allows you to succeed. In fact, all the most successful traders that I've heard interviewed have said that their trading turned around from losing money to making money when they started cutting their losses small, and they allowed their winners to run longer than their losers, but also to add to their winners when they were making money. Okay, and that is, that is so logical, but so few people can actually do that. I remember when FXCM did a survey of 3 million trades, and they said that their customers, their trader customers, were right 65% of the time, but they lost overall because they couldn't cut their losers. Okay, so the most important lesson I want you to walk away with today is to cut your losses, right? Even if you think I'm talking a load of rubbish, that's fine, I don't mind. But please, walk away with this. Put it in your trading plan that, you're going to cut your losses. When you think that the market is not going to work in your favor, you just get the hell out as fast as you can. Conserve your capital and clear the decks, and don't let it, and if you take a small loss, doesn't matter, they're easy to make up. Small losses are a lot easier to make up than large losses. And this is a game of attrition. It's trench warfare out there, right? So you have to cut your losses, and you can't let small losses get to you. In fact, if you do that, what you'll find is that when you make winning trades, as long as you allow them to run, they'll wipe out all your small little losses. So then you'll go from trading on fear and emotional despair. That's when the confidence will come in. You will start to trade as a confident trader. And the market cannot be a confident trader because you have 100% confidence in your trading. So you've got to get yourself to the point where your main objective is to become consistent and to trade with confidence. Okay, so these are the two important points that you've got to take away, and they will come from cutting your losers as tight as possible. Within five ticks. On crude oil, I can trade with 2 or 3 tick stop loss, and not get hit. I think Joel uses an 8 tick stop loss, and a 10 tick is what you want to be your absolute, worst case scenario. You've got to have a worst case scenario. So, moving on, retail traders also think that they do not need trading psychology as they have an edge they need, and the market is a get-rich-quick system. Well, it's not. The market is a get-poor-quick system, right? And you should not think of the market, if you're not approaching the market from a professional perspective and treating it like a business. If you had a corner shop or you had a restaurant, you are not going to allow things to go off. You're going to try and sell your things, even if it's at a discount. You're going to try and sell food or products which are going out of date. You're going to try and sell them before they go out of date, because if they go out of date, that means you've got to take a loss on it. You don't want to do that. So you've just got trading is a business just like any other business. You don't want to be holding on to anything on which you're going to lose money on, because that will affect your bottom line. Okay, you only want to hold on to contracts that you're going to make money with. Okay, so that's if you've got a retail store and there's something in particular that you're selling very well, you're going to keep stocking it. And if there's something that's selling very badly, then you're going to sell that off and you're not going to restock it. So it's you've got to be hard. You've got to fire those trades that don't work, and you've got to hire the trades that do work. And also, what you also have to do is you have to either take screenshots or make videos, and you have to go over your setups, whether they worked out, did they work out, didn't they work out, was there something you didn't see, and what are your strengths? What are your strengths as a trader? Can you build on your strengths? Can you add those into your processes whilst eliminating your mistakes? Don't just focus on your mistakes. Focus also on what you're good at and, build upon that. And that is also a good way to be successful in the future. So, trading on fear, hope, and emotion is 95% of the market. So you might say, well, hang on a minute, what about a trading plan? A trading plan is very important, but how many people can't follow their trading plan? You know, how many people out there have a trading plan and can't follow it? So, you know, you've got to have a trading plan and you've got to stick to it, because that's where your discipline will come in. So if you realise that 95% of retail traders are trading on fear, hope and emotion, right? That means that all of the 5% of the market are not trading on fear or hope or emotion. You know, so they have their trading plan, they analyse themselves, you know, they have trading psychologists, or, you know, a lot of these big firms, they do have trading psychologists. They'll have a coach, and what they'll do is they'll just go through all their trades, they'll look at their average winners and losers, and then they'll suggest ways in which their traders can correct themselves, even prop traders. And I'll tell you something else as well. 95% of graduates out of university, they go to a prop shop and fail. And it's mostly not able to stick to your trading plan, emotion, fear, and hope. Even graduates suffer from it, because it doesn't matter what education you've got. If you're trading on fear or hope or emotion, you know, how can you expect to succeed? Okay, you're not going to succeed. That's why 5% who have a trading plan, they have a set of rules and they stick to them. They analyse themselves, their own performance, they analyse their mental analysis as well as their technical analysis. They're the guys who succeed. Okay, so just, you know, take that on board. So, bad habits that they cannot see. I've probably already touched on this. Making money from poor execution, a lack of knowledge, getting lucky at the start, only to lose it all. Well, I'm sure most people know about the last one, getting lucky at the start, only to go and wipe everything out. So, you know, if you don't analyse yourself through a journal or through some sort of recording mechanism, then you're not going to figure out what your bad habits are. You can have poor execution, not following your trading plan, trading on your gut feeling, trading on emotion. You know, you can make money from that poor execution, but in the long term, you're not going to make money. You're going to give it all back and lose more. Okay, so, you know, discipline. You know, that's basically what I'm saying, is you've got to be disciplined. Okay, so a lack of knowledge, right? So a lack of knowledge is unfortunately commonplace, and it's not anybody's fault. It's just that there's a lot of people out there selling, who are failed traders, who are selling something that's failed for them, and suddenly they think that they can, you know, suddenly start having it put into a computer package or whatever, and then put it on the internet, and then they go on YouTube and they have all these videos on how you do this and how you do that, but they're only trading on demo accounts. They have no real accounts that they can show you or anything like that. So, you know, it's, you know, a lack of knowledge is not always, you know, your fault, or, you know, the fault of the retail. You've just got to, you know, just try and cut through it. And what I would say to anybody is that Joel is teaching price and volume, and just, you know, look at people who are just teaching price and volume. You know, and if in 6 months down the line that you graduated from Joel's class and, you know, you're doing all right, you know, go to a prop shop. If you've got a few $1,000s spare and you've got a month free, you know, just go to a prop shop and just further your education. And they'll teach you quite a lot of secrets. I'm really glad I did it. So another reason retail traders fail is allowing the inner idiot to take over and destroy a good trade by talking yourself out of it. By being your worst enemy, you are trading against yourself. I wonder how many of you have found yourself in that boat, you know, allowing the inner voice, the inner idiot, to take over and destroy a perfectly good trade. Oh yeah, you know, you got a few ticks. Come on, you know, you're not going to go broke taking a profit, you know. And then you close out, and then you find yourself with emotional capital because you closed out of a perfectly good trade, right? If a trade is working for you and you're on the plus side of ticks, let it run. You know, if something's working for you, let it run. And if you really feel confident about it, add to it. The only time your inner idiot voice should take over is when you're in a losing trade and saying, look, come on, you've got to close this out now because you're losing money. You're making a loss. You've got to close it out. And if, and you should think of your trades as employees. A prop shop is a proprietary trading house. It's where they will have clients' money and they will trade clients' money. That's what a prop shop is. That's what they're called. They're just called prop shops, but they're actually a proprietary trading firm. And they're professional traders and they recruit graduates, but they also offer retail courses, things like that. So you can Google that. Once you're 6 months down the line, you've got some money behind you. If you feel as though you want to, go forward and give yourself, like another couple of levels, then that is a good thing to do because they'll teach you about discipline. They'll teach you about controlling your emotions because it's not just about sit-ups. It's a psychological game. You've got to figure out the psychological stuff. You've got to work on your bad habits, and a proprietary trading house will help you to do that. Unless, of course, you're really good at it. Or if you want to, go to Van Tharp and do one of his courses, he's a good trading coach. Down the line, he'll help you to iron out all your bad habits. But you've got to find somebody who's going to help you to iron out all your bad habits and eradicate the fear, the hope, and the emotion out of your trading. So you just approach it from a cold perspective. And that's the only way you're going to succeed. And that's what all the professional traders or the traders who are long-term, that's what they've done. They've eliminated all the things that hold them back, right? Because otherwise you're just trading against yourself. You're not trading against the market, right? I know that you probably just want to see, like the chart setups or, the setups that I'm going to show you. But I think this is the most important part of it. So I want to go through this, but I don't want to spend too much time on it. But I just want you to get the point, okay? So another thing is that they judge themselves by their last trade and they give up too soon. Okay, you've got to look at your trades over a sample size of 50 to 100 trades, or on a week by week basis or a month by month basis. Do not live and die by your last trade. Okay, because you will blow yourself up emotionally. You will blow yourself up. Okay, and that will result in a fear of, you'll be trading on fear and emotion because those will just get to you, and then your trading plan, your edge will go out, everything you've learned, your trading system will just go out the window if you're judging yourself by your last trade. You've got to give yourself a minimum of 1 to 2 months, ideally 3 months, or a sample size of 50 to 100 trades, and then you look over your profits and losses, and, like I said before, you look at them in terms of a percentage. So you express them as a percentage, and you look at your percentage winners and losers. And that's what hedge funds do. Hedge funds, professional traders, money managers, that's what they do. If you ever meet a hedge fund manager, you say, how much did you make last month or last quarter? And they'll say, well, I was up 1%. They won't say, well, I made $500,000 last week. They express it as a percentage. And that helps you, from a psychological point of view, to look long-term into your trading habits. Okay, and your trading, well, not your trading habits, but your performance. It will enable you not to live or die by your last trade, because if you do get if you've had 5 winning trades in a row, and then you get a losing trade and you cut it short, you can say, well, look, I'm up 0.5%. This losing trade is nothing. This is not going to ruin my day. You can't allow losing trades to ruin your day, okay? Because if you keep them small, you can make them up, okay? So don't judge your trades, don't judge yourself by your last trade, and don't give up too soon, okay? You want to be in this game for a long time, you've got to average things out, okay? And that includes, your performance. So another thing you've got to do, I probably touched on this, is you've got to analyze your losing trades, and you've got to try and figure out what your bad habits are, and you have to address those, okay? So words of wisdom, okay? If you're trading on a 15-minute time frame or less and you don't have a trading plan, good luck to you, bro, all right? And I really mean that, good luck to you. Because if you don't have a roadmap, if you're a general in the army, or, something like that, you had to go and invade a country, you wouldn't do it without a plan. Everything has to have a trading plan. You've got to have a business plan if you're in business, and you've got to have a trading plan if you're a trader. It's, Those are the keys to success, and also a journal. Don't forget your journal. Okay, so what makes a good trader then? We've covered all the parts that make a bad trader. So what makes a good trader? So discipline, right? Follow their rules, they don't get distracted by anything, and they don't allow their losing trades to affect their emotional state, right? They're able to stay focused even when they're under pressure and in a stressful situation, right? So, you know, a market might be going against them, you know. They are perhaps, you know, not quite making their profit or loss quota for the month. You know, so there might be other traders who are doing better than them, so that will put them under pressure. So you will find yourself in a stressful situation at times. Maybe most of the time, maybe only, you know, a small amount of the time, I don't know. Market conditions can change, right? The most important thing is that they cut their losses and they clear the decks and they get ready for the next trade. And they don't let their losers ruin their day. Right? You cannot let a losing trade ruin your day. The most important thing, like I keep saying to you, because it's the truth, is to preserve your trading capital. Right? It's what you keep that's the most important thing, because by keeping more money in your account, it means you can keep coming back and you're not out of the market, you're not dead. Right? And that's the most important thing, is capital preservation. Right? I can't emphasize that enough. Okay? So they follow a trading plan, and I'm going to show you mine. They define their edges based on their statistical analysis of an average performance over a sample of trades. Right? I've been talking about this as well. This is very important. Right? Don't look at every trade individually. You look at them over an average. Okay? Expressed as a percentage. And there are a lot of hedge funds and professional money managers, they will actually define their edge from, you know, a statistical analysis of the average performance over a sample of trades. That's how they get their edge. You ask them. You ever meet one, ask them. That's what they'll say. Okay? They keep their ego in check. All right? So if they're making a lot of money, they're doing very well, they don't let it bother them. You know, they just focus on the process. You've got to focus on the process and not focus on anything else. Okay? Because it's a process of how you come to your decision-making process and execution of that trading process. That's what will make you money. Okay? Not allowing all these other things in the background to come in and destroy your confidence. Right? And these guys, these professional traders, they're trading on confidence, and they're trading with a plan. And they don't get distracted, and they don't let their losses, you know, they don't let their losses, you know, give them a bad day. Some of them will even go out and buy something just so they can show themselves that they actually do have money and they're not going broke. And I'm talking about guys who lose thousands of dollars in a day. Okay, it does happen. You know, professional traders do lose thousands and thousands, but they'll make it back. That's why they're professionals. They don't let it ruin them. Okay, so when basic market conditions change, they adapt their edge and position sizing to reflect the changing conditions and not look for a new system. And that's the opposite to what a retail trader will do. Okay, so position sizing is you take your account size and then you take the number of contracts and then you divide the number of contracts by your account size, and that will give you a percentage of which you're going to lose. That will be your maximum loss. Okay, so Dan Tharp talks about this. You can Google position sizing, and there's a lot of resources on the internet. I strongly suggest that you do that. You'll see in my trading plan, I don't actually, I use position sizing, but I actually just use it in terms of ticks and not as a percentage of my trading account, because I actually don't want to have like a 25 tick stop loss or anything like that. So because I've got quite a, you know, I've got quite a good trading account, and I don't want to give more away than just a few ticks. So I'm more strict than that. So, you know, don't forget that market conditions will change. You have to change and adapt. Adapt is a very key word. Not look for a new system, but just adapt your system for market conditions when they change. Okay, so they also hire a coach and a trading psychologist. Well, the firm will do that to keep them at the top of their game. Retail traders do not. Okay, they will keep a journal, analyze their personal performance. They know where they're wrong, and enter as close to the point as they can by patiently allowing the market to come to them and not chasing the market. Okay, chasing the market will almost certainly result in losses. Not a good idea. Don't ever chase the market. You know, if price comes to a point and rejects that point, reverses off that point, you then want to be looking for the price to come back to that point, and if it rejects that point, then that's a low risk, high probability entry, because you know where you're wrong just below that low. So, you know, your stop out will be very low, and that will give you a lot of confidence. Okay, so that's what they do. They'll pick their spot, and they allow the market to come to them, and if they're wrong, they just close out, and they don't let it ruin their day. Okay, they don't go chasing the market because they know that's a surefire way, you know, to be standing on a Titanic, you know, when it hits the iceberg, all right? So they meditate to allow themselves to detach themselves from themselves and see themselves as a bystander. Okay, so that's something else I would recommend that you do. They usually do maybe 20 minutes of meditation twice a day, and that will be very calming for you. It will allow you to see yourself from a detached perspective, all right? So, you know, look at that if you want to. A lot of these professional traders, they play sports to reflect their competitive edge and keep themselves motivated. You have to find things that motivate you about trading. You can't allow yourself to get distracted. Obviously, you don't spend 24 hours a day doing it, but, you know, when you're feeling about the, you know, maybe you just don't feel like it or whatever, or, you know, you just want to have time off, that's fine, time off. But find something that will actually, you know, rejuvenate your motivation and then come back with a, you know, feeling fresh. And it's important to take holidays and have time away so you can reflect, clear your mind, allow your mind to sort of clear the decks and allow things to settle in, okay? So, for a professional trader, it's all about the process and not about the result. I know of a systems trader who has half a dozen trading systems. He only checks his account balance once a year, and that's usually at the tax time. He never looks at his trading account balance. Once a year he does it when he has to fill out his tax return. So it's not about what you make, okay? It's about the process. Don't focus on the result, focus on the process. The decision-making process that defines your edge, that allows you, with confidence, to enter a trade, okay? So don't forget, trading is not about what you make, it's about what you don't give back, right? You want to keep what you make. Most traders eat what they kill. They don't want to kill something and then have to give it to somebody else, okay? So it's about capital preservation, making sure that you can come back, all right? So, I think that's the end of that slide, which it is. Is there any questions on what I've just said? If you've got any questions, just either, you know, come on the mic and say, or just type them in, you know. But if you can follow this sort of plan that I've mapped out for you today, and you think about, you know, what I've been talking about, then you have a better than average statistical chance of being successful over the long term. But it's not going to come to you on a plate. You've got to work at it. It's going to take a lot of effort. I've had to do it. And I've had to put a lot of effort into this. Okay, so Johan says all good so far, so thank you very much. So I'll progress. So anyway, when I was looking at charts, I really thought that there was something missing. And so what I started to do was I started to think, well, you know, you can get in on a test or a new demand, you can wait for this high volley bar, you can wait for that bar, and, you know, and then, Jeremy, I'd like my privacy. You know, this is Joel's event. If you've got any questions, ask Joel. You know, he'll forward them on to me. You know, I quite like my privacy. I'm quite well known in the trading world, and I've kind of stepped back, which is why I haven't been around for, you know, for a few years. There's a well-known charting company that I've done work for, and, you know, and I just decided that I've done 10 years of education, and, you know, I'm just helping Joel out, you know, so I just, you know, I like to keep myself, you know, under the radar. I don't really want to be in the spotlight. I'm not selling anything. You know, I don't have anything to sell. I'm just sharing with you, you know, some of the things that I've come across, some of the concepts that I've come across, and, you know, so anyway, so what I started to do was I started looking at the tape, and this is on the Brund. No, this is the S&P mini, sorry, do apologise. So what I started to do was I started to filter out on the time of sales the volumes over 200 contracts. And what I did was I actually manually, I couldn't do this in person, but then I found actually a way I could do it. But I started to mark all the bids and offers on the chart, right? And you can see here where it's got porting A, because there's A, B, C, D, E, F, G, and that relates to all the numbers from the bottom up to the top. Because don't forget, the numbers at the top come in last, and the numbers on the bottom, it's just basically a single block order, of 200 contracts or more. They're not consolidated or aggregated. They're just like somebody sold 200, 230, 300, 500, and they all come through the tape all at once. All right. And I'm assuming that the CME have not been bundling their they haven't been bundling their data. So anyway, so you can see that there's a lot of trades done on the offer. Okay, so you've got an uptrend, you've got a breakout, so you've got what they call what Coffee's called jumping the ice, or jumping the creek. Sorry, not jumping the ice, but jumping the creek. You've got this sort of down wave. It comes up, it retests it, comes up, and then you can see. Then you can see where all the volume starts to come in, and you notice how you've got this point A. If you look at the high, and then you look at bar E, got quite high volume on there, and you can see they try to break out of the high, and this is where all the retail comes in. All the retail comes in, and they start buying the high as a breakout, because that's what they do. They go to these classes, and they're taught to buy breakouts, right? Well, breakouts don't work. They do work on occasions, but you've got to know what you're doing. You've got to know what you're looking for. But on this occasion, it didn't work. So it broke the high. You can see that it's all in blue. So all the trades, they're hitting the offer. They're buying the market, buying the breakout at the market, trying to get in. They don't want to waste an opportunity. And then what happens? The professional traders know this, and they're just sitting there. And what they're doing is they're just waiting for all this sheep to come into the pen, and then they're just going to get slaughtered. And that's what happens. They're fed everything they can take. The then price comes back, and then it comes up again, and then they start hitting the bid again. Right? So this is, you can see that the volume's quite high down here. Okay, you can see that there's quite a lot of volume and a bit of momentum. There's a lot of professional traders that will buy down here on these lows, and they'll sell the breakout because they know that that's a typical trap for retails. And, if you want to make money in this game, you've got to figure out where the traps are. And if you can figure out where the traps are, then you've got, a better than average chance of making money. So, obviously on bar J, you've got an up bar. You still got quite high volume, so there's still a push. There's still people coming in and buying because they think it's going to break out again. So they're all buying in anticipation. And then, of course, what happens is they all start, the professional traders start hitting the bid. So as it downticks, they'll hit the bid, and they'll sell a large block into the bid, taking out the bid. And then what they'll do is they'll just keep hammering it. So that's what they've done here. They've hammered the bid. All the volume in blue, all these little sort of dots on the bars in blue, they're all trades bought at the offer. So that's basically market buy orders, and all the red ones are sell orders into the bid. Okay, so when you see the blue ones, they're buying into the offer at the market, which is retail behavior. You can tell that because of their position. And then you can tell as it comes back up again, then they start putting market orders into the bid, and then they start hammering the bid down. Okay, but you can notice how the market tries to break out, can't. Okay, comes back down, has another go at it, and of course, there's a lot less volume. If you look at the volume down here, it's a lot less than these two bars behind it, which are like skyscraper volumes. So as you can see on the retrace, you can see there's no more buying because there's no more blue. And what you have instead is red. So as soon as the market starts to turn down, you don't sell into the up bar, you sell into the down bar, because that's where the momentum is. The momentum is by the professional traders. Because how do you know it's not going to take out that high? And this is the problem that I had with the volume and price technique, is that it goes up on low volume. You think, right, okay, it's come up to an old high on low volume. You think it's going to turn, so you sell it, and then it breaks the high. Of course, it then takes everybody out, including yourself. So then what I realised was that what you've got to do is you've got to look for rejection or continuation. And in this case, it's the rejection of the highs. So once you see or observe that there's a rejection of the highs, then you know that there's a good probability that the market is going to reverse, especially when you see them hitting into the bid like that. You can see that there's all retail getting all excited because they're all buying at the market, and that's where all those large offers are. But as you can see, when it retraces back up there, you can see that, on like the third attempt, there's just no buyers in there. They're all exhausted. They've all got in on the previous bar. So you can see when the market turns down then, after it's gone back up in low volume and it hasn't broken the high, that's rejection. I'm going to show you a little bit more of that as I go on. So, when the market starts to then turn down, that's when you want to get in. You don't want to get in on up bars. You want to get in when just as the market's turning and keeling over, after exhaustion, after a rejection. Okay, now that's the way that I've figured out to be not the greatest probability or the highest probability, but you've certainly got a lot better chance of actually turning a profit than if you were to just blindly sell an up bar on low volume into a previous high volume up bar, because you don't know. It's an up bar. It could it could continue. They could take the high out again, bring in more suckers, and then reverse the market down, and then you're in on an up thrust. Because that's what you've got. You've got an up thrust here in the background. Because you've got to break out the old high, and that's what an up thrust is. It's basically all these guys down here, they're all short, they're all closing out above the high, and new money's coming in buying the breakout of the high. So there's a perfect opportunity for professional traders to find liquidity and then liquidate and then sell short into a perfectly ready market based on stops and false breakout expectations. Okay, so I'll go through another slide. I've got a couple of questions. Are you comparing price of trade nearest to the bid or the ask to determine if it was a buy or sell? Well, if you're looking at a chart, you will see that most of the activity is on the offer. So that will give you a big tip-off that, there is a lot of buying in there. So you don't really want to sell into that buying. You want to wait and see what the result of that is. Okay, you need to see what the result is, because what you're looking for is rejection. So does it continue higher and break out and then test that high? Are all these guys who are potentially underwater going to get out of jail card? So you've got to wait. You've got to wait for rejection. It all depends on what you're actually looking at. If you're looking at, say, like an order flow chart, which is like, well, in Sierra chart it's numbers bars, but you can get like a footprint chart, and the footprint chart will show you this. A footprint chart will actually show you what what I'm talking about, and most importantly, it will show you when you get a breakout, you get a lot of trades on the offer. Like if you're looking at a footprint chart, this one, you'd see that most of this was actually on the right side and not the left side. Whereas on these bars, it would show you mostly on the left side and not the right side. Okay. Yeah, it's Sierra chart. Okay, so that explains it. Thank you very much. What is the charting package? Okay, so Sierra chart. Okay, do they jump the creek only to sell off on the other side? Well, it all depends. I'm not really what I call. Well, there is a group of people called Wyckoffeans, and I don't really consider myself to be a Wyckoffian. Richard Wyckoff never talked about jumping the creek or any of that. That was somebody who took over that in the 1950s. I think probably didn't know. I think his name was Bob somebody or other, which then his name deludes me. But breakouts are dangerous. You can see the first bar closes below the low, right? So there's pretty much rejection, but then the next bar doesn't. The next bar closes higher. But look, you've got a bit of a down. You've got a wave there, a selling wave, which turned out to be a buying wave, because although there were sellers there, Those sellers then would have been stopped out around about here. Okay, then, new sellers would have come in on these dips, allowing professional money. You can see how it couldn't break that low down there. I don't know if you can see my mouse. I can't find any drawing tools on this GoToMeeting. So, you can just see that, you see the low, you've got this low in the background, then you've got another low, and then it can't break that low. So there's a rejection of that low. So what that tells you is that there is buying momentum here because the sellers are exhausted down here. And this is what you need to look at. I'll go to, I'll get this chart package up and I'll show it to you. And I'll go in more depth because I'll have a crosshair. But, you just look at the highs and the lows. You look at the price bars. Do they reject those highs and lows? What is the volume in relationship to those highs and lows? Okay, when you see rejection, you've got a high probability trade that the price is going to reverse and go in the opposite direction. Okay, and hopefully by showing you, these sort of dots on these charts, it allows you to see, what I'm talking about. And this is how I really started to get interested in price and volume. So here again, here is another chart of the E-minis, 1 minute chart. And you can see here on the left side, you've got a red bar there. And you can see how on bar B, you've got high volume in the sub bar, and they try to buy the breakout again. They just, it's just a fool's paradise. They buy the breakout, high volume, market reverses, okay, and then it tries to go up on bar E, and they start hitting the bid. Price goes up, but then when price starts to fall back from the high of that bar, they're aggressively selling into the bid, hitting the bid with large blocks. This is professional traders, right? They're hitting into the bid with large blocks, right? And they're doing it on D, E, and F, right? And then look at it, right? Again, they try to buy on RG, they hit the market, they hit the offer. What happens? Nothing. Well, guess what? Those trap traders on this blue dot at bar G, that gives you a wonderful opportunity to sell into with a limit order. You can place a limit order there, or say like up here, the market doesn't go up there, and you don't know where the market's going to go. You don't know how far up it's going to retrace. You don't know if it's going to keep on just going down. If it's going to retrace, you don't know what it's going to do. Nobody can say with absolute certainty what the market is going to do next. You only have, a probability of what the market might do next because the future's unwritten. If you go to the right edge of the market where the last bar is, what's the next bar going to do? You don't know. Nobody knows. Not even professional traders know. They don't make it a priority for them to know. They just adapt to, the ebbs and flows of the tide. They don't try and fight the tide because they know they'll go broke, and you sometimes read about it. People like Nick Leeson, there was another trader from UBS, they called him Mr. 3%, he lost billions of dollars. He lost over $1 billion. So if you try and fight the market, it doesn't matter who you are, it doesn't matter how much collateral you got, you will go broke, all right? But what this does is it allows you to set yourself like a benchmark, or give yourself a price level. And this is the beauty of the time and sales, is it actually enables you to see exactly what price level all this activity is happening on. So instead of saying, well, I've got to make my decision over 4 or 5 ticks, you can say, well, hang on a minute, there was a large offer. Somebody bought at the market at that price in the background, and the result was the next 2 bars were down. So therefore, somebody bought, they were sold, somebody took their offer, somebody took their order, and yet still had more to sell, went to market, pushed prices down, then that seller has, stopped selling, allowed the price to come back up to its original point when we sold, and then he started selling again. And this is what you get. The market comes back up to this level where this blue dot is on G, can't get above it, because that seller, he will be defending his position. But the beauty is that it gives you a reference point in which to enter the market. And if you're wrong, what's your loss? Your loss is just a few. So there's a very good probability that the market is, it's already in a downtrend. It's not going to go up. You've just got a retracement. And even if, it went above G, then, you've got F and you've got E. So it definitely wouldn't go above any of those bars. And the trend is down. You can see how somebody waxed a bid on bar H. I'm not quite sure if that was somebody buying at the lows. It could have been somebody buying at the lows. But look, there was no follow through. The market just reversed down. The market, there was no interest. There was no buyer interest. The market was weak and nobody was buying. So, you know, all the sellers, they had to go to market, and that's what pushed the price down. Okay. So here again, we've got another chart. This is again of the E-mini S&P 1 minute, and you can see here. I showed you bids at the top of the range, and it's also true at the bottom of the range. When you start to get, you know, large blocks at the bottom of the range, that's usually buying. So you've got these large orders that have come in, these large bids that have come into the market, and they've actually stopped. You know, they stopped the downtrend. And you can see it here where you've got this downtrend. Price starts out on the low, and it finishes, you know, almost on the high. And then it goes up on low volume, retraces back down, because then the buyers stop buying. They don't want to pay higher prices, so they stop buying, and then price comes back down to them to a point where they actually start to buy again. Okay, and you can see that on the bid. As price comes back down to the very low, they step in and they start buying again. And you can see that from these large bids. Okay? Now there is a large buyer on bar C. It's probably not a retail trader, but I've just had a message saying that all of you not all of you may be getting the video, so just let me know if that's the case. So on bar C, you've got what appears to be a large a large buy order into the offer. The market then, that buyer will step away. He'll allow the market to come back a few ticks. He'll step in and buy, push price up, stop buying, allow price to come back to him. And then this is why you want to buy these lows, right? When you get these retracements, you're looking for rejection of these lows. You're not looking to buy on a low volume down bar. You're looking to see if price comes down to a previous low, and what does it do when it gets there. And as you can see, almost all these low bars down here, the price comes almost back down to it and then rejects it. And as the price starts to go back up, you look at the volume, you start to get the volume. This is rejection of those lows. So what that means is that people, you know, traders are stepping in and they're actually buying. And as you can see, there was some buying there, but they stopped buying and allowed price to come back down to the lows, and they stepped in, they started buying again. And then there was more buying. As you can see, these, you know, it's quite healthy volume on these up bars. But you can see, you know, you've got not excessive high volume, but you've got increasing volume on these up bars. But when they allow the price to come back to them, they're not selling. Right? They just, you know, they're allowing the retail to come in and sell. Look at the volume. The volume is low. That's retail activity. That's not professional activity. Comes down to the low, then they start absorbing again, push the price up. And then you've got these breakout traders again. You know, here they are again, buying the breakout. You know, jumping the creek. And then, so what happens is, then they get trapped. Price comes back up on low volume, as you can see, comes back down. They start to get stopped out. Price comes down, it rejects the low of bar E. So you're looking at the very last low bar, you can see that's bar E. So, you know, you're paying attention as it comes down with low volume. As soon as you start to get the next bar, which is an up bar, you say, right, okay, this is demand coming in. Because you can see an increase in the volume, and you can see an increase in, you know, this bar will turn around pretty sharply. So you can say, right, okay, I've been looking at the low of bar E, so now I can see that 3 bars after bar G, that's a rejection of the lower E, and you can buy. And if you're wrong, you just get out for a few ticks loss. But as you can see, if you come over to the left side of where this window is, where all the time and sales are, you can see 24,983. You can see that high. I'll put a line across it. And what have you got? You've got the Johnny Come Latelys and the breakout traders again. You know, the guys who got in at bar H, they're lucky. You know, they got away with it. But all these guys who are coming in around 2009, the price level 2009, you know, they're about to get sunk. Okay, so, you know, yeah, that bar before Jeremy was an up first. So you can see that the message I'm trying to convey to you is that, you know, order flow will give you a greater insight into where the turning points are, and then you can see, you know, from those large trades that appear on the tape, you can see, you know, from the result of that, does the price go up? Does it come back down? Does it test on low volume? Does it reject the low? Does it reject the price where, where those large bids or offers occurred? And if they do, well, then you've got a low risk, higher probability trade of it, of it reversing in the opposite direction. So, you can sit down, you can figure it out, you can backtest it if you want to, but, you've got a plan. You can make a trading plan off that, and it probably will be successful. Okay, here again, you've got, right, here again, here's a volatile market. This is a ranging market. This is not a trending market. So a trending system would not work on a day like this, right? So, price is all over the place, and you can see, as price comes up to these highs, you can see that people start to buy expecting a breakout, and what happens? They just get trapped. And then you've got an up thrust here, but it can't break the highs, but you can see that there's trapped buyers up here. All these guys who bought at the highs, they're all trapped. So what happens is, yes, they're given a get out of jail card, but there's no follow through. If you look at the volume up here, the volume's quite high, but if you look at the volume up here, the volume is low, and you can see that. So all these guys are all getting trapped. So what have you got? You've got a rejection of this high. On this bar, the 5940 bar, you've got a rejection of this high bar back here, around about 1520 or something like that, 1522 or something like that. I don't have a pen that I can mark it off with. So, you've got rejection. So that's an increased probability that the market's going to reverse in the opposite direction. What happens when it comes down to the lows? They step in and buy the bid. They start to absorb all the selling. You can see you've got high volume on a stand bar, and then you've got a rejection of that. And then buyers start to come in. Then you start to get the breakout guys. They start to get trapped by the professional buyers. They don't want to buy at higher prices. That's what the retail do. So they obviously allow the market to come down. Now there will be some guys who will be defending their long positions, but ultimately, it couldn't break that high. So when it reverses down, you've got a short trade there. So you don't want to be selling these up bars. You want to be selling the next bar, because that tells you that, the upside has failed, but there's no professional support, there's no buying momentum, and that, the professional traders are not supporting the up move. They're allowing prices to come back down so they can keep buying at the lows, and that's what they want to do. Right? And you can see here that they hit the bid, and they hit the bid again. You can see right on the same price level, as price comes down, a wide range down bar, closes off the low, when it hits this bid, there is some buying down there. And then if you look, it stops. And it comes back down, and then you can see, look, they're buying on the bid, but right on the lows. You see? Now, what will happen here is that below this lower point E, you'll have short sellers coming into the market. All right? You'll have a lot of stop losses being triggered. Now, a lot of those shorts may possibly get stopped out around the 2006 price, as price retraces, where you've got the 8076. Before it comes back down, and then all these buyers up here, they're in a trap, and what happens is that it breaks the lows, they all get stopped out, the guys who all bought at these high prices up here, they all get stopped out, under pressure, it brings in new short trades, okay, but what happens is, we got a spring, because that low is rejected, okay, and this is what you're looking for a rejection of the lows, right, so the market comes down here, it stops, we've got what you call a bad low, it comes up, locks, stops out any shorts down here, traps in any traders who are buying there, then it retraces, and then it stops out all these guys who bought in here. Anybody who's still long down there, they're going to get out, because if they bought at the bottom, they're going to get out because they think that the price is going to go below and stop them out, which it does anyway. So they'll all be closing out their positions. So there's a lot of liquidity down there. Professional traders, they know where the traps are because they create them, or they take advantage of them where they think that the retail are going to get, trapped, and they can see the order flow. That's what they look at. They look at order flow. So you can see here as price comes up. Now this could be, what this could be is defending of any shorts that are up here. They could be defending or they could be getting out. I'm not quite sure. To be quite honest with you, I can't explain every single movement. I can only generalize on it. But I do know that the action is on the offer on bar J. So bar J, we've got 324, and I think we might add 343 and probably 413. So there's a lot of contracts up there. So the market gets knocked down a bit. It's climbing the ladder, but it gets a whack, and then it gets knocked down a couple of pegs, and then it climbs back up. It's able to absorb and push them higher. And once you start to see that it's pushing above and accepting, above that price level, then that it's, there's real buying momentum there.
I wanted to point out, Sebastian, what you've been drawing the attention to the viewers. Here are two breakouts that have failed. They, as you were calling it, they trapped them.
That's right.
The amateurs are selling at the lower point E, and they're selling again at the lower point H, and they think they're getting in on a sure thing. And in fact, in truth, they are getting in on a sure thing. What Sebastian's been telling you is they're getting in on a sure loss. Back to you, Sebastian.
Okay, yeah, thank you. So this is why, hopefully, it's important that you understand that you've got to look at the highs and the lows. And you try and say to yourself, if I was going to create a trap, where would I do it? So this is why you look for, if the breakout works. Bubba, that was Joel who came in, a deep voice. Obviously, I don't have a deep voice. So you look at the highs and the lows, you look at the volume in relation to each other. So you could call them swing highs or lows, I suppose. And you can see rejection, okay? And you can see that there's a lot of short selling down here, like I said, and then the trap. Okay, but there's traps all over the place. There's traps on these highs. There's another trap there. Traders get trapped up in there, they get stopped out down there. You get shorts coming in here, 5684, then they get stopped out when it comes back up and retraces the high of the previous high. Then you get new buyers coming in. They get trapped, the other guys, they get stopped out. And this is what it is, it's just a washing machine. That's all the market is, it's just a washing machine. It's just going, it's just washing one party in, and washing another party out, rinse and repeat, rinse and repeat. And that's how it works, that's how the market works. It works by drawing you into a poor trade, reversing on you, stopping you out, and then drawing somebody else into a poor trade where you get stopped out, and then reversing on them, coming back down to where you originally, got short. By then you're too frightened, you're trading on fear then. And then, I'll come to that in a minute, Sam, just be patient. And then that's all it does, it's just, you've got these, these up waves and then down waves and up waves, and every time you make a high, you make a low, there's traders getting trapped. They're getting trapped on the highs, they're getting trapped on the lows. And what you've got is like a flipping action. So, so like down here at point E, you'll get guys getting stopped out down there, and you'll get new shorts coming in, new money coming in. They're getting trapped as price reverses up, and then those guys that are getting trapped when prices reverse up, they're getting stopped out potentially down here. Then you've got new shorts coming in, then they're getting stopped out, and then you've got new guys coming in who are expecting a breakout, and then they get trapped. So this is what happens. This is how, if you want to understand how the market works, this is how it works. It doesn't work any other way. The market is designed to take your money. It's not designed to give you money. And it's the professional traders manipulating price into where they perceive. It's no different to a sheep farmer with his dog, and he drives sheep from one pen to another. And then eventually, the auctioneer comes along with his lorry, and then the farmer will then round all his sheep using a dog, and he puts it all in the trailer, and the trailer goes off to the abattoir, or they go off to be sold, and that's all it is. They're just sheep being led to the slaughter. Because, so why do they do it? Why do traders buy the highs, or sell at the lows, and then get stopped out on the reversal? Because they're trading on emotion, right? They're trading on fear and hope and emotion. And this is why people do this. They're mostly trading on emotion. And this is why I say to you, if you can eliminate the emotion from your trading, you'll start to coldly see, objectively, what the market's trying to do. And then you'll be able to say to yourself, well, hang on a minute, maybe I can come up with a plan which will define my edge, and then maybe I can actually turn this to my advantage. Perhaps, instead of fighting the market, being emotionally trapped in these poor positions, perhaps I can detach myself from that, and then I can potentially see where other people are getting trapped, and then take advantage of that. Because that's what the professionals are doing. You know, they're just looking at the market, they see where you're getting trapped, and then they'll trade against you. They'll push the market in the opposite direction. And this is how you've got to change your entire way of thinking. All right? You've got to change your way of thinking. So here we have some news. You can see around about, well, you can see up here you've got more guys getting trapped, more traders getting trapped as they anticipate a breakout of the high. All right, the market reverses, and as you can see, you've got somebody hitting the bid. Perhaps somebody was long from back here and they're trying to defend that, I don't know. But anyway, market comes down, and then it reaches a point perhaps where there's, you know, like a trading range in the background. Price comes up, starts to go up on low volume because I've got a little indicator there. And then you can see that they're starting to hit the bid as price goes up and comes back. So you've got uptick and then downtick, they're hitting the bid, uptick, downtick, they're hitting the bid. And then price goes up at 13.51. It can't get above this trading area in the background. And you see that a whole bunch of traders come in with an offer, they buy the offer, thinking it's going to come back up again. And they think they're clever. And what are they doing? They're getting stranded. Right? So when you see that large offer coming in on a, you know, like a small uptick over a couple of bars, you know that people are getting trapped and you can trade against that. Right? Price comes down, finds a level. You can see that down here that the market's found like a base, it's making a base. And you can see where professional activity is, you can see where they're, you know, there's probably traders just selling the low. And their orders are just hitting, they're just selling below the low at sell stops or something like that. And they're really going to make a big bid, but ultimately, price comes back to them and puts them under pressure. And then you've got, you know, more traders hitting the bid, comes down, you know, they might be scalping for a few ticks, so you see the buyers come back in again. And then you can see this is on the down bar right at the low, there's probably some accumulation in there. But notice how it comes back down to where these lows are, around about between 1403 and 1407. You see how it's made a low? But it comes back down just after 1415, it can't break the low. You see, it cannot break that low, you've got rejection. So the professional traders can see that, you can see that they're buying like crazy, right? So they're going to ride it up until just before the news. And you can see that all these guys who bought here before the news, whatever that was, they're now getting stopped out down here. Right? And there's going to be new traders coming in, they're going to be selling the breakout to the downside. They're all going to get trapped, you know, and then they're going to get whipsawed and the price turns around because there's professional traders sitting there with all their bids. So they hit the bid and they stop the down move, it then reverses up. You've got more traders coming in, they're hitting the bid. So instead of selling into the bid, they're actually buying into it. And then that pushes price up. And then it comes back up to this original point where these guys got trapped in here. And assuming that they're still in, they're holding on, they're going to be getting out. You know, so they're going to be getting out. And then when price comes up here and stops, you're going to have more traders hitting the bid. Then they're going to be selling on the downticks. So it's come up, and then it starts to downtick, and then they're going to start hitting it. Because prices come up, it's going to slow right down. Because the buying momentum is going to stop. You know, it's like on a piece of elastic, and then at some point that elastic is going to, the energy is going to run out, and then it's going to stop or slow right down. As soon as traders realize that, then they start selling it, and that's what happens. But no, it comes right back down to the lows, all the way back down here, just after 1439. It comes back and it rejects the lows. It goes below the low, but it rejects it and starts to come back up again. Well, that's your buying opportunity, because you don't know what's going to happen below this low. You've got no idea, I've got no idea. You can see all these guys, some of them got away with it for a few ticks, but, you know, a lot of them probably got stopped out because they didn't close out. They didn't scalp it. They just, you know, I'm sure that there are some sellers below this low that are somewhere trapped in there. So, you know, you look for the highs and the lows. When you see rejection of them, well, you know, there's your low risk entry. So, because it's been rejected, you know that it's probably not going to go through it, and you know you're going to get a few things. It comes back up here and then it gets rejected. You know, you've got buyers come in and then they step off. I don't know what their intention was to bring it back down here and buy more with the lows, but, you know, when you see these highs and lows and then they, you know, price stops and, rejects, then, you know, you've got, you know you've got a low risk entry potentially. So anyway, I wanted to show you that slide. Right, there's something else that I want to show. I want to go on to the next bit. Right, okay, so I've got, should have, okay, so that's that, new text. Right, so I'll just quickly run through my trading plan. This is my trading plan. Okay, so this is tabbed. Okay, so I'll quickly run through my trading plan. Okay, so this is my end of day analysis. Right. So okay, so this is my end of day analysis, and then I'll get rid of this, and then hopefully I'll have my trading plan. If not, you'll have to give me a second to bring it up. So end of day analysis. So I print this sheet off. So the end of day is mental analytics. No, I do journal. I have a video journal and I also make notes. I have a diary. I keep my my journal in my diary and I actually handwrite it. So, okay. So anyway, so mental analytics, right? Psychology. Emotions felt when pulling the trigger, right? So I felt, well, I felt fear before I pulling the trigger. I wasn't sure if the trade was going to work out. I had my stomach was telling me that I shouldn't do it or whatever. My inner idiot was telling me that I shouldn't do it. Okay, so does fear enter before or after pulling the trigger? Well, you might pull the trigger, find yourself in a trade, and then you think, well, hang on a minute, this trade may not work out. And then it's like that inner voice, like the inner monkey, the inner idiot within you saying, oh, close out, it's not going to work out, close out, you got a bit of profit. And then you close it out, and then that's going to cost you emotional capital, because if then the position runs 10 or 20 ticks, and you've closed out after 2 or 3 ticks profit, well, you're not going to do very well in this game, are you? And if you're just stopping out for a few ticks, then you're just going to be break even. You don't want to do that. Okay, so you've got to conquer the inner monkey. And I think that only I'm going to send the sheet to Joel, and he can send it out to you. I'm going to email it to him. So a lot of emotional blocking that traders get is, can I focus after pulling the trigger? You pull the trigger, and then you can't focus on, you can't see anything, you can't focus on what you're doing, because it's that fear. You've got like this blindfold on your all of a sudden. Your emotions are so strong that they're actually preventing you from focusing on what's actually going on. So then, does fear enter before or after the pulling trigger? Well, after about 6 months to a year, you should say it doesn't. Can I focus after pulling the trigger? Yes, I can. How long can I focus during the day? Well, most people can only focus on for an hour or 2 hours at a time. So, if you find yourself, if you find yourself, just write down on a piece of paper, when you think you're able to concentrate and when you think you're not able to concentrate. And look at the time and try and, keep a timestamp. And then what you can do is over the weeks, days, weeks and months, is you can actually look back at that and get an average of the time of the day when you can focus and the time of the day when you can't. So you focus on, your performance or taking the trades that make the most sense to you during that time. You can focus, right? Because everybody can focus on certain times of the day, and they can't focus at other times of the day. So, part of the process should be identifying, what times of the day, you can focus. And most people, it's in the morning, the morning session, or other people it's in the afternoon. But you've got to figure out, what time of the day is best for you when you're going to be most focused and when your emotions are going to be the most under control and you're trading on confidence and you're not trading with fear, okay? So obviously you'd write down better morning or afternoon, and then you can answer the question of, am I in danger of trading on euphoria during or after a positive result trade? Well, obviously, you're going to have to, depending on what happens, you would fill that in. And then you can look at that every day and you can say, well, actually, that was quite strong when I started out. When I started making winning trades, my euphoria was quite strong. But after 2 weeks of writing this in, it's getting less and less and less. And this is another thing you're trying to do, is you're trying to figure out these things that are working against you or in your favor, are they getting stronger or are they getting weaker? So like if you're trading on fear and you're trading on emotion, but you're making note of it and you're exploring that within your own psychology, is it getting less and less and less? every time you trade. So like if you get, so like goose pimples, or you start to shake when you pull the trigger and you enter a trade, you know, do you time yourself on that? And then do you time yourself the next time? Is it getting less and less and less until you don't feel it at all? You know, I'm sure I'm sure you're intelligent enough to get it. So you can also write down, what are my strengths today? You know, what are my weaknesses today? How much patience do I have whilst I'm in a trade? You know, am I cutting my profits too short? You know, should I be waiting longer? Should I be more patient? It's just stuff like this, just self-analysis that will help you to better understand yourself and therefore help you to make better decisions in the future. So do I panic and exit for a small winner? You know, obviously you're going to know the answer to that one. How do I feel when the opportunity presents itself to catch a runner? Well, that's something else you can write. You know, did I miss it? You know, how did I feel? Did I not feel that the trade would work? And then what I do is I study it, and then I find that it does work, and so therefore I'm kicking myself in the foot. Okay, there's stuff like that. You know, do I feel anxiety before clicking an entry? Do I fear the trade will work against me? Do I have deep-seated memories of previous losses? Obviously, that's something you can fill out. Am I able to continue with my trade after my daily limit? You know, what processes should I be working on to improve my trading, right? And then obviously you would work that down there, and that's a very important one you should focus on. Okay, are you following your trading plan? A very, very important question. If not, do you have a trading plan? Another important question. Okay, and do you feel, and if you do have one, you know, are you following it? So, and every day you've got to, you know, put a yes or no saying, do you feel that filling out this sheet is helping you every day? Okay? So, does that make sense to you guys? Hopefully that makes sense to you. Right, I'm going to try and get in my directory and see if I can dig out my trading plan. Because I should have my trading plans. Yeah. And there's a possibility that I haven't got it with me. I haven't got it. I've got it, but I'm going to have to go into my cloud. So what I'll do is I'll just focus on, what I'll do is I'm going to focus on my chart thing, and then I'm going to let Joel take over for 5 minutes, and then I'll go into my cloud and I will get my trading plan.
Why don't we do that now, Sebastian? You can go in and get your trading plan, and I've got a thing or three I can throw out and keep the people entertained while you're doing that.
Okay, it won't be long. What I'm going to focus on is crude oil. CL, I think that's it. Not sure. Right, okay, so if you want to take the screen then, Joel, and I'll go and get my trading plan. I've obviously saved it and not realised that I've saved it under a different name as well.
Okay.
I've actually got a print.
You have to give the presentation back to me.
Okay.
If you want me to look at my screen, which I have nothing prepared other than following the trend of market merchandising is what Sebastian was getting at. And it's what the market's all about. It's to transfer money from the... nothing is being shared. Okay.
I'm just going to mute my mic for a couple of minutes.
Yeah, well, right now I got to figure out... nothing's being shared, but I assume everybody can hear me. So, what's this? Okay, there we go. Alright, share my screen, okay. Okay, this is the first time I'm using this for a presentation, and so far it's working wonderfully, apparently. And all of you get gold stars. My trust, my confidence that we're all adults and we could get together and have a level of discourse of this nature. Would everybody be behaved? And everybody has behaved. So that can go back to what Sebastian started with, the inner game. And that's where the Holy Grail is. It's inside of you. What you're seeking is right where you are. Everybody can hear me, is that right? Is there some way somebody can tell me that I'm being heard? One of these little things pops up on the screen. Loud and clear, fabulous. Like I said, it's the first time I'm using this, and it's working. Look how well it's working here. So, okay. You've heard me say this before, and people have understanding of something. They word it differently because they have different backgrounds. Sebastian's background is different than mine. I didn't put any restrictions on Sebastian as to what he could say, what he couldn't say. I simply asked him to share his wisdom with us, and this is what happened. And he's saying the same things that I'm saying. You're getting consistent message from the two of us from disparate sources. And he's talking about trading being a probability game, and that is exactly what it is. Putting the evidence on the chart in your favor, and you become a speculator, not a gambler. Beyond that, that inner game is the difference. He's telling it to you, and I've told it to you because it's the truth. The Truth Brigade. The game is won or lost inside. The fact that matters is that the patterns are the same for every one of us. Does everybody get that? How cool that is that the patterns are identical for everybody. Everybody can look at the price, everybody can look at the volume, everybody can look at the dome, the ticker tape, you'd call that today. And Ney was a tape reader, Wyckoff was a tape reader, God knows what Daniel Drew did. So the fact is that Sebastian hit it right out of the park to begin with, and saying it's inner game. And it's a process. It's not an event. Absolutely, it's a process. And Sebastian hit on market conditions. Know your conditions. That's why we have trades that are time trades to the minute, and we have ways to trade news. News creates volatility. Let the market unfold and make those decisions for you. Sebastian brought up protection. Capital preservation, he mentioned. Same thing. And that's having the tightest stops in all of trading when you're buying like pros do on declining prices and you're selling on rising prices like they do. And hope is not a strategy. It doesn't, either you know what you're doing or you don't. Either you have a plan or you don't have a plan. You get in a trade, you know what your stop loss is. You know when to raise that stop. How much to raise it, when to make it break even. How much does it make after it breaks even that you move your stop here? Back to it being a process. Sebastian talked about the adult dollars, the big money, the girls that run these hedge funds with the billions. They're looking at a month. Not on what you do on any given day. Things happen. Different days offer different opportunities, and it's how you trade it, how you manage the trades. You look at things over time. You become a speculator because you know the pattern works. And you know that the pattern works, that gives you confidence. When you have confidence, voila, you have no fear. You know what you're going to do. You know how you're going to respond to the market. Sebastian?
I'm ready when you are, Joel.
Pardon me?
I'm ready when you are.
Okay. Then take it back. I'll give you control again. I'll give you this screen and
Okay.
let me find your name here and get to it.
Great. I'm going to have to re-download it and save it as a PDF. When I did it, I was in a bit of a hurry and didn't realise I'd actually renamed another document. So, okay, so here's my trading plan.
Just so you know, Sebastian, again, this is new technology. I've never used it before, but sure seems to be working great. I set this meeting up for 2 hours. And that means we only have another 22 minutes. I don't know if it's going to go kaboom and we can't talk anymore, if you want to talk anymore. So just letting you know there may be a time constriction at this point. Back to you.
Okay. I'll speed it up then. Okay, so my trading plan, this is my own trading plan, obviously. So what I've done is I put in the contracts I'm trading, which is the German bond. And possibly I've got an option to trade the 10-year, the 30-year, and the S&P mini in the future. The FGB M and the FGBL, that should be FGBL, I'm going to have to rename that. That's the German bonds, which is just German 10-year bonds. So these are my commissions, 85 cents to $1 per side, depending on the volume. I've got trading technologies, it's $50 a month. And that comes out my account on the first, and it's 60 cents round trip per bargain. The hours I will trade from 8 a.m. till 16:30, which is the German market. And if I trade the CME products, it's going to be 1300 till 16:30 with a break, and then 1800 till 21:15. And the setups I will trade, so I look for absorption, cumulative traded volume, look for reloading on the bid or the offer, enter at the same price or a price below. So another part 2 will be, this is separate to the first one, but if I come across this and I'll trade this, I look for where price slows down or stops, cannot go through a price no matter how much effort, and then I buy the retest of that price. Another trade setup I will see, I will use if I see it, will be inside the value area, so I look at TPOs, and then I'll look to scalp the book. Obviously I can't cover that in this session, and if it's outside the value area, if you just look up TPOs, TPO chart, time price opportunity, you'll see that it shows you where value is. It's very important to know where value is in the market, because price, when it goes away from value, will usually reverse and revert back to the mean. So look for reversion back to the mean, and with position plays or pyramiding. My trading, my setup part 4 will be pullback. If price goes bid or offer, bid or offer, bid or offer several times, it can be up and down, then I will look to trade the retracement of that. So my examples, this trading platform is TT. So reloading on the bid. So you can see down there, you've got the bid, which I think is 75. I think we're looking at 75. So you've got 140 contracts at 75. So let me see if I can just make this a bit bigger. Okay. Zoom. Okay. If I can just get this a bit bigger, right? Okay, so yeah, that's a bit better. Right, okay. So, so after this image, you'll see absorption as price. As buyers lift the offer, you will see a downtick into the bid. So the bid is at 75, and then the sellers will take out the bid, and then the bid will disappear and then reload by 170 contracts, right? So if you look at 75, there's 140 contracts. The market's trading at 76, so it's traded 190 today. Bought 190 into the offer at 76, and 36 is now left to trade. So what happens then is they take out everything on the bid. So you've got 131 now trading to 75, which is on the bid, and then immediately 76 the offer reloads. Okay, so now you can see that the sellers are taking out a bid, and now there's a vacuum on the bid, right? Because it's now blank. Right. So what happens then? So immediately it reloads on the bid. So then another 132 contracts are added to the bid, right? And then that transacts and then push the price up to 76. So in my notes I put buyers were able to reload the bid before sellers were able to force price down 74. This is where you have to buy at the bid at 163.75 and hope you get it filled. Reload and a hit. So a reload in a hit is when price disappears at 75 and then somebody lands another 100 or 200 contracts, and then a hit would be it goes offer at 76, right? Ideally taking out the offer, which is 125 contracts looking to sell. And as you can see, they lifted the offer and they hit the offer and took out everything that was on the offer, and then immediately they reloaded 92 contracts on 76, and they would have also reloaded on 75. So if I see that, then I will immediately look to buy 75s, maybe buy 76, or maybe wait for a further retracement into 75s, see if the 187 sticks. And if it sticks and it doesn't disappear, then I will look to either add on to 75 or buy 76s. Okay, so another one will be where if this can work in either direction. So the price is in a downtrend, so it's come from, say, 164.20, and then the price you want to be interested in is 164.12, right? So you've got to watch that price, and it cannot get through 164.12, okay? So absorption, price could not bounce higher. So it comes down, 320 contracts trade into the bid, but they won't allow it to go offer at 164.12, and 164.11 cannot go bid. You've got 347 contracts traded. So if you look, it then goes offer at 13, and it takes, they buy 167, leaving, what was it before? It was 162. So they buy 167, they reload 131 on the offer. And then what happens is that it then downticks into 12, right? So it comes back down to 12. Look, there's only 2 traded into the bid, right? And they're reloading the bid, right? But they've also reloaded the offer. So then 541 trades into the bid. They take out all the bid, and then the buyers start to hit the bid at 12, and then you get 541 because what you have is possibly an iceberg order down there, but you've got reloading of the bid, but they're also reloading on the offer, right? The price cannot get through to 11. Price cannot trade through to 11, right? So the sellers really try to push through, and they can't do it, right? So the result is they try to push through 12s, they couldn't do it. So as price starts to then lift the offer, and this is what I'm saying to you, right? So I was showing you with those charts, when you see price rejection, and the price cannot go through a price level on your chart at the lows, and you start to see it tick up and reject that low price, or on the flip side, on the high price, then you want to start aggressively thinking about buying, because it's going to reverse. And hopefully that's on the price ladder, which is what I use. I look at the order book. This is what I use to trade. But you can also, if you can, get your mind around it, you can see that on your price charts, and you can look for the same principle. So I've got a couple of other setups that I've got to add into it, but I haven't got around to it yet. So my trading plan continued risk, very, very important. Is that a question or is that feedback? Okay. So my loss limit in ticks per trade and total euro-dollar per loss per day is euros, 100 euros per day. So that's a 3 tick stop out per trade with a maximum of 500 euros a week, right? The chances are that I'm not going to hit that. And I may not even hit the 100 euros a day. But what it does is it enables me to stay in the game, right? So, and it also enables me not to have a bad week. The chances of me losing 500 euros in a week is probably not going to happen. But it's my worst case scenario, okay? So it asks for 3 days including commission, right? So what will I do after the maximum amount of trades? Either my target or my stop out is I'll go on the simulator for the rest of the session, okay? And then I'll try and figure out what I was doing wrong, or I might look at the video. So my strategy for increasing and decreasing my trading size is if the high and the low, the mean reversal trade in play, spoofing either highs or lows, then add to position or pull back whilst in the trend. So if it's in an uptrend and I see that it's on a pullback, and then I start to see spoofing on the offer, and I start to see aggressive reloading on the bid, then I will go in, or I'll increase my position size. Or if it's going against me, I'll just get out. So I'm looking to make 15 ticks a day, but as experience grows on the ladder, then increase the target. Consistency is the objective, and that's what it should be for you. How many trades do I plan to make per day? 5 maximum per day if profitable, and then as many as comfortable. Do I plan to hold on to my winners? How long do I plan to hold on to my winners and losers? Okay, until I see buyers or sellers enter the price ladder, which will be on my winners or my losers. Bids offers start to thicken up and price cannot continue, or high volume on cumulative volume, and price starts to slow down or stop if price slows down through exhaustion. Then I've obviously got a decision to make. Reporting. Write sheet after review, which is my other one that I showed you. Use trading technologies, trade analytics showing performance over the session. Try to find errors by not following the plan. Look at the time of trades, duration of time of trades, monitor when good trades occur, measuring ticks, time duration, and ladder activity. So within TT, you've got this trade analyzer, and it will show you, a lot of what you need to do. So obviously I've showed you in my sheet, my mental analytics. I actually separated that onto a day sheet, separate sheet, which I look at every day, which is also part of my trading plan. So video journal, I video everything. I want to follow, video my trades, annotate errors on the videos, or annotate correctly interpreted edges for repetition to subconscious. I upload videos to my private YouTube video channel for later, or I share with a few select people. I've got to make sure that I can come back and trade tomorrow, which is why I've got to keep my losses under control, right? So what number do I call if I get my systems fail? That's my broker's 24-hour number. And so what should I do if I get my internet connection checked or fixed if I needed to? I call my telecom operator, which is Sure. Okay, so that's basically that. So I'm just going to quickly show you now some charts, hopefully. Right, I've got my charts. So what I want to show you is what I showed you on my other chart. What I've done is I've put it on a footprint chart, and we've got about 11 minutes left, so I'm not going to dwell on this too much. But you can see, I showed this to Joel the other day. You can see here, this is why you need to study order flow. Well, you've got to have, time and sales or footprint chart or something like that. So you can see here the people at the high up here, they're all getting stuck. Right? So you've got a breakout, you've got a lot of buying initiative. There's a lot of trading on the offers. I'll just expand this up for you. I don't use this charting package anymore, which is why it's giving me these error codes, because I've now got a different broker, so I'll try and get all this stuff out of the way. So you can see here where I've got, buyers and sellers piled in, and you can see all the bids and all the offers. Obviously, you've got two-way trade there, but the buyers managed to get a foothold. But, then they become exhausted. And then you start to get a pullback, and then you've got less volume than you have up here on these other candlesticks. But you can see how traders are starting to get trapped up here. In this, sort of pullback, you start to get people trapped. So price then, obviously these guys are getting trapped, and you see how you got the reversal trade, right? So you got rejection of that high. See how it comes up, can't get up. You've got guys being trapped on the highs as they're buying a breakout. You've probably got other guys who shorted down here, they're getting stopped out. But you can see how when you get a reversal bar, you can see that's where the selling comes in. You can see they're all hitting the bid, and then it floats down, and then it comes back up to where these sellers initiated here, can't get above it, and then look, you've got more buyers getting trapped, and then price has no option but just to fall. You end up in a downtrend until you just get mass panic down here, and then what you'll also find is that you'll get other traders coming in. See, where all these guys bought, if they didn't liquidate up here, they're going to defend their positions. And that's what they're doing. But ultimately, they can't defend their positions. Well, that's actually where I run out. So, price probably might have either come back down and retested it, or it could have broke it, or it could have just reversed up. I'd imagine by the weakness in the background, it would have just continued. It's making lower lows and lower highs. So, there's one example. I'll see if I can find you some other examples.
While you're looking for example, Sebastian, I'm certain that some of our attendees will have questions, and I have a question from someone who wasn't able to attend. He was wondering if you had a formula, a trading plan to determine at the beginning of the day whether it's going to be a trending day or a range-bound day.
Yeah. You can write down on a piece of paper your pre-market analysis, so preparation is obviously very important. So what I'm going to do is probably create another sheet, just like my end-of-day analysis sheet. I'll probably do like a pre-open prep or something like that, where I'll write down all sorts of questions that I would be asking myself. And what I'll do is I'll send you a copy of that as well, Joel, when I've done it. But yeah, that's what I'm going to do. So yeah, and it's very important to plan your day as well as review your day. So when I've got that, which will probably be, not too long, maybe the weekend, I'm just trying to get everything written down. I've got everything in my diary and that, but I just got to translate it into paper, rather than just sort of, doing it online or whatever. So here you've got, I'm just trying to give you perspective on how people get trapped. So you can see you've got a lot of Johnny-come latelys. They're all getting trapped as they come marching in, start buying at market. At which price, all these guys down here, they've probably been stopped out. And then professional traders obviously have, like a market to liquidate into. So all these buyers, they're getting liquidated down here. Market comes back up. Some of these guys are getting out of break even if they held on. You've also got new money coming into the market. Okay, but most importantly, that high could not get broken. It came up close to, but it couldn't get broken. You can see all the volume on the offer. That's 200 and something contracts. This is crude oil. So what does it do? It reverses down. So, a good play for you would be to, put your highs and lows. Are those highs on high volume or low volume? And when price revisits that high or the retest, is the volume high or low on the retest? And does it reject the high? Can it not get through it? Does it come up, touch it, reverse? Does it do an up thrust where it goes above the high, stops everybody out, brings in new money, and then comes back down again? So if it can't even get up to it, it's even stronger. So you just buy, the reversal bar. And as you can see, they come in, but look at the volume here, it's even lower. The volume on this bar is even lower than the volume on this bar, right? So this is not going to go up and break the high. They can't even get above the high on that high. So as soon as it comes back down again, you've got a good trade there. And then look what happens, it just comes off. What I'm trying to do is just trying to, give you examples of how, if you want to succeed in this game, you've got to understand how, volume and price come together and interact with each other. Because price is just an advertisement for people to transact. Because the marketplace is just an auction, that's all it is. And prices get pushed around, it's looking for liquidity, and if it can trap you in those, if it can trap you at the same time, it will do it. And there's a perfect up thrust. So here you've got some two-way trade back here. These guys are buying in, they're getting stopped out down here. You've got new shorts coming in here, and all these guys, you've got new buyers coming in along the way, and you've got a breakout, which then fails. This is an up thrust. So you've got market orders coming in, you've got stop losses going off, you've got all sorts of behavior going on here, and what you've got is you've got the perfect opportunity for the professional side of the market to liquidate into. And that's what they do. So, they reject that high, and then price can't get above it. And as you can see, you've got no demand over 2 bars. It rejects the high of this bar, and it also rejects the high of this bar back here. That's why I've drawn the line. And then what happens, it reverses. And then what happens is, sellers come into the market and they start hammering the price. And then, there's no way it's going to go up.
Does anybody have any questions for Sebastian?
Bubba, I don't have gold futures on here. I've only got crude oil. You can see where, there's mass liquidation going on. You've got other traders that are coming in, selling the breakout. They're selling the breakout, so there's a lot of, hitting the bid below that price. But you can see that the result of that is that, even though there's all that volume, it does actually generate a pullback because there's so much pressure down there. You see there's so much selling, and also the professional traders are liquidating their shorts. So as it comes back down again, you can see that low doesn't get broken, it gets touched, but you can see that it doesn't get broken. You can see there's a lot of buying down here. Because when you see large bids and offers at the lows of the range, that's buying, and if you see it at the high of the range, that's selling. Okay, so maybe if you want to get yourself a time of sales, and then that will, maybe make things clearer for you. As it comes back up, it then comes back into where this original selling took place, and then those sellers are still short. Then they defend their positions, because professional traders will defend their positions. They don't get stopped out. Professional traders do not get stopped out. They hedge or they defend. They've got the money to do it. And that's what you can see. You can see rejection of and defense of these shorts by the professional money here. That's what happens. They'll defend it. So you know, this is just a continual, endless cycle. I saw it just goes on and on and on and on like a washing machine. And here you can see, again, you've got price comes down, takes out the low, and you can see all this buying down here. Price comes up, you've got buyers getting trapped, comes back down to the lows, it rejects the lows, and you can see they're still buying, they're buying back into those lows. Professional traders buy into lows, they sell into highs. Do not make the mistake of buying breakouts or anything like that, because you're just going to end up, you're just going to end up in a trap. You see, look, price comes down, you can see professional traders liquidating, buying, they push it down, they reject the low, right? You can see more buying. This, unfortunately, I've got these time sales windows, which are a bit of a nuisance, but get them out the way.
Time, Sebastian.
And then it reverses. Then you can see all the Johnny come ladies. Then they all get trapped, they all get stopped out, you get more traders buying there, and then they try and do the breakout, and then they get trapped, and then price reverses. So if you want a good trading strategy using price and volume, just look at the edges, the fish around the edges, they're not in the middle of the pond. Anyway, Joel, do you want to take it back for the last minute? I think I've probably made my point.
Yes, you made your point about inflection points, and it's a great point. It's a critical point. This is how you do succeed in price and volume. You find the extremes, and you find out where price is either accepted or rejected, and those places are inflection points. You can see how here, where Sebastian has the perpendicular line 2 bars over, you had a bar that they tried to break out, and they sucked people into the trade. Amateurs were buying on that bar, and they broke out of the bar back in 1401, and that's why the order was at that level, and price was rejected. It was not accepted, and that's what you need to look for. When price gets to these critical spots, I call them order flow levels. It's where money's exchanging hands between pros and amateurs right here in front of your very eyes on every chart every day. So the point needs to be driven home and taken home. You figure this out, you recognize this pattern, you react appropriately, you're going to make money. So let's thank Sebastian here for his time and his generosity, for sharing this wisdom with us, and perhaps he'll be kind enough to come back and spend some more time with us after we have a chance to digest this. Does anybody have any questions? Looks like we're able to go a little longer here. Does anybody have any questions for Sebastian? You're all being generous with your appreciation.
Thank you for that. I appreciate that.
You saw me start the recording, and right now I'm going to stop the recording in front of everybody here. And